Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we are taking a look at Palantir, ticker PLTR. And this stock definitely is not a value stock. It is potentially a growth stock, and we're going to look at what the bullish scenario would be for the stock. Because on its face, fair value being generous, we're coming up with, let's say, $3. Which means a margin of safety. We'd be wanting to get into the stock with a 20% margin of safety, around $2.33. In the last 52 weeks, it's been as low as $5.84, as high as $20.24, currently sitting $14.86. Discounted cash flows is coming up with 70 cents. So this is one of those companies where they're on the brink of profitability. And there's a whole lot of hype behind the company here and their growth potential. So we're going to see what kind of potential do they need to reach fair value and continue growth into the future. For starters, their earnings yield is currently negative. They haven't shown a profit yet. This year, they're expected to come in with 23 cents in profit. Next year, 27. Ideally, we'd be looking for 74 cents at the current share price. At the fair value would be, of course, much better earnings yield, more in line with what we're looking for at 5% plus. Cash flow yield, they did actually have a decent year of cash flow this last year with a 9.6% yield. The year before that, 20.8%. So cash flows are starting to come in positive. They had been negative before that. Of course, not turning a profit, they're going to have a negative ROE. And ROI 2.4%. So for growth, that is definitely not good, that ROI or the ROA as well. Their returns are just not good. They look like they're getting better year after year, but still definitely not something good to start off with. Debt to equity is looking really good. They are paying down their liabilities very quickly, and they're growing their assets quickly as well. Margins, gross margin, 78.5%, net margin, negative 19. And that's the story there, is incredibly high expenses. They are investing in infrastructure so that they can grow faster, but we'll see how that actually pans out. You see right here, gross profit. They've come in with very high, very good gross profits, almost 80% margins, great, almost to be assumed for a software type company. But expenses come in very high, 108% of the revenue for last year, 126, 207. So they've never been good about their expenses. And one of the main issues here is the stock options that they give to employees, and that is likely contributing to the fast growing share count as well, which is probably the main thing that's holding back this company and its growth. So it definitely looks like one of those founders get rich and investors get screwed type companies. Revenue, we have seen some decent growth historically in the 30s. Analysts aren't projecting as much going forward. If we're trying to find a path to the current value, we're going to need even higher revenue than they've come in previously, most likely. I mean, it's not a huge number to start off with. One of the main issues is their very low margins. I'm actually going to have to try and say, let's assume that they're going to come in with 20% margins in the future, just to update some of these numbers and try to bring us a bit closer. Earnings per share, they've slowly been trending positive. Of course, it looks negative because of that trend. It's not bad. 82 cents, $1, 27 cents, 18 cents, and then it's going to be positive going forward, 23, 27, and hopefully more out into the future. Cash flow growth is actually decent. They went from negative to positive with, again, decent yield this last year and the year before that. So if they can keep that up, hopefully hold around the 10% cash flow yield, things will be looking pretty good going forward. Share count, huge issue here, growing 8 to 10% year over year. Assets are growing very nicely, 29%. Liabilities are shrinking very nicely, 38%. Dividend is non-existent. So over here, I have some estimates to try and bring us towards a fair value that would give us a bullish case. And if I match just what they've done historically, 30% revenue growth, let's say, because analysts are projecting lower in the future. Share count growing 9%. Assets growing 20 is okay. Liabilities shrinking 22 seems fine. And a dividend non-existent. So 3 years out off of all of this, we'd be looking at a fair value of the stock of $4.10. And in 5 years, that would grow to $5.46. So is the issue here just the growing share count? What if we say nothing? They just hold at the current share count. It's better. 528 for a 3 year, 834 for 5 year, but they definitely need to be buying back shares in order to actually move the needle on anything. If we say they buy back 1%, since they're growing them so fast, we end up with 544 for 3 year, 876 for 5 year. So again, it's definitely not where we're sitting at today's prices. The lower end of this year's is what we'd be looking at 3 years out at this type of growth. So what if they can come in with higher revenue? They can pick it up, get up to 40%, a bit better, at least 5 years above $10 now. And what if they grow their assets a little bit faster, maybe 25%? That doesn't seem too unreasonable. Buy back liabilities at a similar rate. Okay, we're up to 1130 for the 5 years. And this is assuming that they're going to be coming in with a 20% margin on average over the course of those 5 years. So it looks like we're going to need a margin even higher than that. What if we say 30%? And at that point, we're getting a little high for a normal company. Software might be a bit better. That's $13.12. That's a whole lot better. And what if we bring it up to 35%? $14.03, much closer to today's prices. Say 50%, they're able to cut their expenses down significantly because they have a super high net margin, 79%. If they can keep their expenses low, then we would be looking at something in 5 years. So obviously, the moral here is the share count growing is definitely screwing them, and they need to lower those expenses. The balance sheet looks great, going in a great direction. Some of the financial numbers are going in the right direction. Cash flow is looking a whole lot better. Earnings are starting to go positive. So there is some good here, but the issue is the good may not necessarily be worth the hype that the stock is getting. It probably should still be sitting down at that 584, and it's going to take a whole lot longer for it to reach this type of potential. Because quite simply, what we're looking for is something where the PE, so the price of the stock is 15 times earnings. The cash flows, so the cash flow per share times 20 is a reasonable share price. And the net assets per share times 3. So in that case, we're looking at $1 for earnings per share, 74 cents per share in cash flow, which means that we'd want a net cash flow somewhere in the realm of $1.5 billion. And last year they came in at $1.9 billion for their revenue. So that looks like it's trading at a huge multiple for those cash flows. And the final thing, that balance sheet. Net assets per share of $4.95. Again, multiply that by the share count. We're looking for $10 billion in net assets, where the current balance sheet sits at shy of $3.5 billion assets and $800 million liability. At the end of the day, hopefully the takeaway from this is how to value a stock, at least a little bit more, and not to get caught up in the hype of some of the stocks out there on the market. Because yes, there's some huge growth potential. It's on the cusp of profitability. This year will probably be the first year of profit, but we're not going to see the type of numbers to back up the current valuation for the company for about 5 years, even based off of some of the best estimates here. The share count, they're probably not going to stop growing that. The revenue, we came in higher than they have gone in the past. Assets and liabilities are definitely reasonable numbers, but they need to triple their balance sheet, and they need to 10x their cash flows and 4x their earnings in order to reach the valuation that the market currently has set for them. And that's just not reasonable. With how risky it is too, you need to put an even bigger margin of safety on it. It'll be one that'll be interesting to keep an eye on, because it might just be one of those insane growth stocks that moves completely opposite of the fundamentals. It really doesn't seem like it's one of those. It's gone up to 20 in the past and it crashed back down to 5. So that'll likely be the case again. It's just the AI hype again and again and again, even though their product is nothing special. And if they're banking on government contracts, those are some of the worst companies that you can invest. I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And we'll catch you next time.